Happy Monday, everybody. I hope you had a great weekend. There's a lot that happened last week, so we're going to jump right in. Today is the 24th day of January 2022, and this is your Monday market update video. So in case you missed it, we had one reprieve last week. Monday, the market did not go down because it was closed for the holiday. That was the only way we got the reprieve. So let's talk about what happened, the market action for last week, some of the causes, and what the damage looked like by the end of the week. Then let's talk about what we're going to be watching this week. No rest for this week, another big week, so stay tuned. Let's talk. So as I said, Monday was the market holiday. Tuesday, we came back, opened the week, and some were ready to go back into the holiday after we saw how things were going to go. So the 10-year hit multi-year highs, 10-year yield hit multi-year highs, along with Goldman Sachs and Schwab coming to the table with disappointing earnings before the bell, and a total miss on the Empire State Manufacturing Report, the economic for the day. That meant that stocks were under pressure from the start. So the high valuation tech names were leading everything lower. The S&P 500 was down 1.83% before the end of the day. The Dow was down 1.5%, both down more than 4 or 5% from their most recent high. Way back when, that was earlier this month. Remember, this is not a lot of time has passed in this. The NASDAQ was down another 2.6%, the lowest it's been in 3 months. In correction territory, down 10% from its most recent highs in November. Again, quick moves here. We've been talking about this move for months. I've told you that it's going to come. And the more people that believe that stocks could never go down, we knew that it was going to be more and more painful. So remember, it's only a 10% move. We're coming off the backs of some pretty amazing years. Remember, we're coming off the back of 2021, which was the second year of COVID. And that year, the S&P 500 was up almost 27%. 2020 was a year of the first year of the pandemic, right? Shock to the world. And the S&P 500 was up 17% for the year. And 2019, that quiet year, the S&P 500 was up 29% for the year. So we've got to keep all this in perspective. 10% definitely hurts, but let's remember that we've been talking about this for months, and it should not surprise us. It always does, but it should not surprise us. So Wednesday morning brought about new earnings, this time strong earnings from Bank of America, Morgan Stanley, as well as some other big ones like Procter & Gamble and United Health. All of these were up in the pre-market, so there was an early attempt to move stocks higher. Then without a catalyst to help keep that going, the few solid earnings and stable bond yields were not enough to keep the market from the high techs from selling off and taking the rest of the market with them. The S&P 500 finished down about 1% on the day. Thursday brought what everyone knows always happens, right? When you think about it, everything's going to keep falling. We get a snapback rally, of course, right? The stock opened a gap higher on good economic numbers, stable bond yields, and even some easing out of China, all setting up for that normal snapback rally that everyone we know happens now, right? So unfortunately, that was short-lived. The stocks rolled back over later in the day. The moves that we saw were incredible. The Dow had a swing of 800 points from high to low, ending the day down 313 points, or just under 1%. The S&P 500 swung 125 points to end the day 50 points down, or 1.1%. And the NASDAQ swung over 500 points up to down to end the day lower, down 187 points, or 1.3%. There's a lot of news, but not a lot of new news, right? So the market's heavy. It's trading that way. We know that. We know that high-tech, high-valuation growth names are the stocks to hate these days. It may be time to start nibbling at some of the highest quality names in this group. Focus on quality. That helps when you have to justify the valuations. Probably not just yet, but probably getting pretty close. Friday came along, and in keeping with the week, the NASDAQ composite declined 2.7%. The Dow Jones was down over 450 points, and the S&P 500 was down 1.9%. The NASDAQ posted a 7.6% loss for the week. That's its worst since September 2020. And now it sits more than 14% below its November record close. The Dow and the S&P closed out their third straight week of losses and their worst weeks since 2020. The S&P 500 is off more than 8% from its record close. I do want to point something out here. I just stated that all three indices posted their worst losses since 2020. And earlier, as you may recall, I noted that the S&P 500 was up over 16% in 2020. The last time these indices performed so poorly. So what will 2022 bring with poor performance in a couple of weeks and a couple of months? We'll have to see what that comes to be. But again, remember, a 10% sale in the markets, and in many cases, a sale of 50% off of some individual names or more, is sometimes is certainly something that we've expected and something that often brings opportunity. So on a note of what a sale, or as some call it, a sell-off, can bring, there's also another asset class that everyone thinks can never go down, has also had a pretty rough couple of weeks. It's off 40% from its 2021 highs. Yes, that's crypto. Crypto has even been able to go down in this market. So just to wrap up this week, and then we'll preview this coming week, Fed week again. So remember that we've been talking about this move in the market. We knew that it was coming. We also know that although not everything bounces back the same way, quality companies with great businesses and great earnings selling this far off their highs should be looked at, and that's exactly what we're doing now. So coming this week, what are we talking about? The focus will primarily be on the Federal Reserve. They have a 2-day meeting Tuesday and Wednesday, and then a press conference on Wednesday afternoon with, of course, Jay Powell. Two things we're going to continue to watch. First, surprises. As we've discussed in these videos before, the market hates surprises, and we've certainly seen that happen. The second thing we're going to look for is the tone that Powell comes about in his press conference. It's always important. It will be this week as well. The Fed put, as we've known it over the last couple of years, is virtually gone. So what is it that remains? And this is going to come out in the tone that Jay Powell speaks. In addition to the Fed, earnings are going to come into focus. As many have said, after a few high-profile earnings disappointments last week, we're going to have to watch earnings this week. We came into last week focused only on the Fed, and in some add in some earnings questions. Now we have to worry about the Fed and earnings. This week we're going to get IBM, we'll get Microsoft, we'll get Tesla, we'll even get Apple, just to name a few of those. We'll continue to watch to see how inflation does or does not eat into corporate profits. Finally, the week won't be done Wednesday. We still have GDP numbers as well as all the employment numbers on Thursday. Friday is going to bring the big inflation watch numbers. Remember, we've talked about that before. Employment cost index, PCE price index, that's the one that the Fed really likes to watch for what's going on in inflation. So as we can see, 2022 is not yet a sleeper kind of a year. If you thought that we'd be boring at this point in time till the midterm elections come about, think again. So this makes it all the more important to keep an eye on your plan. Make sure that everything is in order. You can always call me, email me. We'll review all of this and see if changes are necessary. So let's keep sharp. There's a lot going on right now in this market. Stay safe, stay warm. Have a great week. We'll see you on Friday for our planning video.